Thanks so much for tuning into this earnings conversation with Persistent Systems. They come in with a quarter which, compared to their standards, is believable. Compared to what's happening to the rest of the IT pack at large, it's a splendid one. 9.8% revenue growth, EBITDA margin expansion to the tune of 90 basis points quarter on quarter, and a 14% jump in profit after tax. Sandeep Kalra joins in to talk about how he would say they've just done the normal thing, but on the back of that, what does FY23 look like as well? Sandeep, great having you. Thanks for joining in, and congratulations on a splendid quarter.
Thank you, Neeraj.
So, when I was looking at Q3, Sandeep, and I went back to my notes, you had spoken about how all client buckets had done very well, which shows in the confidence that clients have in the abilities of Persistent Systems, and it showed in the deal wins as well. Can you tell us whether it was more of continuing the same in quarter four, or was there something else that added on to the sheet?
Sure. So let me start with summarizing the quarter gone by, so that I can set the high level context, and then we can get into a discussion on the details. So from an overall perspective, as you rightly said, Q1 to Q4 have been stellar for us. Last 3 quarters, as in Q1 to Q3, were again 9.1% and in thereabouts. So this is the 4th sequential quarter of 9% growth. So Q4 came in at 217.32%, 32 million. Year on year, this translates into 42.2% growth in dollar terms. In rupee terms, it's 47.1% year on year. And from an organic growth perspective for the quarter, this was 6.8%. You would remember we had announced some acquisitions as well. So there is a contribution from the acquisitions in the 9.1% that we talked about. On an organic basis, this is 36% year on year. Now, full year revenue is at $765.6 million. From an EBIT perspective, we came in at the same EBIT as the last quarter, despite taking in the amortization from the acquisitions that we announced earlier, and things like additional ESOP to the people who got qualified to have the ESOP and so on. So there were some tailwinds, there were some headwinds. Net, we have been able to manage the margins, and it's a good operational performance in addition as well. The other thing that I would want to say is about the dividends. From a dividend perspective, we announced a final dividend of 11 rupee per share in addition to the interim dividend of 20 rupees. So it makes a total dividend of about 31 rupees per share. Now, we've talked a lot about the numbers, but let me also say this. We are equally well pleased with how we have used our capital allocation, done the right acquisitions, and these are not for revenue, but for capability. So we had acquired SCI for payments, and we formed a payment business unit with that. Data Glove for reinforcing our Azure capabilities. So we have formed the Microsoft business unit with that. Then Media Agility, which we are about to close in the next 1 to 2 weeks. It's about reinforcing ourselves in the Google space. So if you look at how even some of the industry analysts are looking at it, we have an absolutely enviable portfolio in terms of whether it is Salesforce, AWS, Azure, Google, IBM, the 5 companies that make or break the technology world. So overall, good foundation for the future growth to come. So that's where we will look at.
Yeah. So actually, okay, can you talk about how was the client experience this time around? Because you grew across verticals and across geographies, I believe, in quarter 3, and I presume in quarter 4 as well. And if I'm not wrong, as per guidance, services did phenomenally well, and IP, after a good Q3, now will continue to kind of compress, so to say.
So let me give you color on both. The total contract value, if you look at the full year, is in addition of $1.2 billion. It's roughly about $1.22 billion. That's the total contract value. The annual contract value is at $943 million. That should give you some sense of where we are headed. Now, in terms of the industry segments, the BFSI vertical grew the highest in this quarter, 10% sequential quarter-on-quarter basis. Healthcare, life sciences, software, high-tech segments saw 9.2%, 8.5% Q-on-Q respectively. So overall, fairly healthy growth. Now, this is also on the back of, if you look at it, the revenue is a lagging indicator in terms of the bookings that we did in the past. So some of those deals are coming to fruition in terms of revenue ramp up. And so the customer experience in terms of pipeline, in terms of deal wins, etc., that we have, fairly good. Macro environment, obviously, we are watching. We are watching what happens in Russia-Ukraine conflict. That is, again, it has a little bit of semblance in terms of what you see in attrition patterns. This quarter gone by was a stable quarter for us, actually dipped in terms of attrition. But we'll see if this conflict goes on, which we hope it doesn't. But if it goes on, then it'll put further pressure on Indian talent. And till the time the supplies, kind of stabilize in terms of newer, fresher intakes, etc., we'll see. So net pipeline is good. What we are seeing from our partners, the hyperscalers, we've been meeting them over the last 3-4 weeks as well. As soon as the quarter ended, we were on the road. So they are also bullish. So far, so good. We'll watch the macro environment as it goes along. But short to medium term, good prospects.
Yeah, actually, sorry, can I just squeeze in one more?
Sure.
Since we brought that up, most companies that I've spoken to thus far as well, Sandeep, your peer sets, don't quite say that the client conversations don't suggest any issues with the macro challenges that are happening on the US side or the conflict that is happening in continental Europe. Is your experience the same?
Yeah. So far, if we look at it, the experience is the same. So far, everyone is watching, but nobody has taken a step back. People are fully, glued into the programs that they had embarked on, the newer budgets, etc., what were planned for this year. They are going in line with that. So far, the pipeline does not reflect any weakness on these accounts. So far, so good. But one has to always watch the macro trends.
Okay. Where I'm getting conflicting opinion though is the nature of the deal wins, wherein some companies are saying they are certainly not seeing any long-term deals and are only seeing short-term or short tenor deals which get completed within a year and bunched up. Whereas some are saying that there is an equal division between long-term and short-term. What's your experience at Persistent?
So if you were to look at the numbers and let the numbers do the talking, the total contract value for the last quarter was at $361 million. The ACV was at $261.9 million. So that definitely means that there are longer term deals also that are being awarded. Now, again, we have to keep that in perspective, that the digital transformation deals. So if you are embarking on a digital transformation, agile based, deal construct, they are not usually the deals that will come in at a 3-year or a 5-year. If you're doing an offshore development center capacity based, construct, that can come at 3-year, 5-year. You're doing cost reduction based construct, that can come in at 3-year, 5-year. So it's a mix of things. So I would not be too concerned about it as of this point in time.
Okay. 9th straight quarter of margin expansion as well. The question is on this base, with the attrition issues, or if it remains an issue, do you reckon that you can maintain or continue on this path? Also, are you seeing a positive response to repricing conversations if you are having them in the first place?
So I think you summarized it in your own way. So if you look at it, there are always going to be puts and takes. The puts and takes are, you will have these attrition related issues and they may remain at the same level, maybe go a little up or down. So that puts pressure. There are things, wage hikes will come, amortization will come. All of those things are, the negative side of it. But at the same time, US inflation is at 8.5%. So if you look at it, the customers that we have, 80% of our revenue comes from US, 10% roughly from Europe, 10% from the rest of the world. So we have a fairly good position in terms of going back to our customers. They are empathetic about it. They're willing to, as the contracts come up for negotiation or, come up for renewals, they're willing to give us a higher pricing and the newer bids are at a higher price. So give or take, our attempt would be to maintain the margins in the same bracket, despite, various things which are industry specific and company specific things like amortization from the acquisitions that we've done. So that would be our attempt.
Okay. Or even employee expansion in nearshore locations, maybe with lower realizations. I believe Mexico and Canada were those points, at least in Q3, that will not quite hurt your operational metrics too much.
So there may be small bit of a give and take here or there, but look, if you look at the margins, maybe a little bit, tad bit here or there, but the bigger picture of things is there's been more offshoring than before. So from that perspective, look, all these are operational levers. We as operators of the business are confident. There may be short-term perturbations here or there, but in the overall bigger picture of things, our attempt would be to be at the same levels or a tad bit lower, not anything significant.
Okay, I have 2 more minutes with you, so I'll take 2 more questions. One is on the guidance for FY23, and more importantly, when do you hit those milestones that you've spoken about in the past? But that's my last question. Before that, just one question. After a seasonally weak Q3, Europe was expected to bounce back. Even if it has, and I would love your view there, I haven't seen that particular metric, to be honest. But even if it has, could there be issues for Europe in particular because of this thing? And are you watching confident? Are you keeping a keen eye out?
Sure. we look at our perspective on Europe side of it, we have seen from our company perspective, a good uptick in our pipeline, good uptick in our deal closures. So from our perspective, the quarter was good. From a European perspective, our pipeline is fairly decent. Now, obviously, the conflict, has more bearing on Europe than the US. So we will have to watch as we go along. In the shorter run, we are not seeing any knee-jerk reaction, but in the longer term, obviously, we'll have to watch. So that is the answer to your European side of the house. In terms of the bigger milestones, look, we have done ACV bookings of $943 million. Now, obviously, some of that has been consumed through the year. Some of them will be the backlog that we carry forward. And then we have the full year to perform. So from that perspective, 4 to 6 quarters, somewhere between that, we'll hit our $1 billion. And, obviously, we'll let it pan out. Now, beyond that, obviously, we are not stopping here. We have built a very strong set of capabilities. We have built a good leadership team. We have very good customers, good relationship with our, partners, the 5 big hyperscalers and industry-specific, alliances that we have. So, hopefully it'll pan out well for us, building on the momentum that we've had. So I'll leave it there.
Okay. Well, since you've given the broad picture, I'll not get into the minutiae now, maybe the next quarter. Anyways, I've done my time with you as well. But great quarter, Sandeep. Thank you so much and look forward to talking to you again.
Perfect. Thank you.
Yeah, thank you. And viewers, thanks for tuning in.